All right. We will continue to admit folks to our forum today. Welcome, everyone. My name is Pamela Doherty. I'm the Senior Director of Gift Planning at the San Francisco Foundation. Before we start our program, I have a couple of notes and instructions for you as we convene today in this virtual environment. The first thing I want to tell you is that we are recording this meeting today, and a link of that recording, along with the PowerPoint slides we'll use today, will be sent out after this meeting. Only the presenters and those who ask questions at the end will be on the video. So if you'd like to stay on your video today, we would invite you to do that. We will have a couple of ways that you can ask questions today. We have left time at the end of the presentations for a Q&A session, but you can send questions in at any time during the presentation. You'll want to use the chat feature and send those questions to the chat moderator, who will be me, and I will collect them for you, and we will respond to as many as we can at the end. So again, send your question to the chat moderator. The other option is that during the Q&A session, you can come off mute and ask your question directly live on the video. The last thing I want to say is that our session today goes from 1 to 2 p.m. For those of you who downloaded the calendar invite from the registration, you may have a 90-minute block of time, but we will be going to 2 p.m. today. Again, thanks so much for joining us. And with that, it's my pleasure to turn the presentation over to our CEO at the San Francisco Foundation, Fred Blackwell.
Thank you, Pamela. It is really good to see everyone today, and welcome to our investment forum. This is one of my favorite events because it is one of the few places where the kind of full breadth and diversity of our relationships in the community are in the room together. We have donors, we have members of our board of trustees, we have professional advisors, we have nonprofit partners who have agency funds with us. We got foundation colleagues, and it's, like I said, one of the few times over the course of the year where all dimensions of that those relationships are in the room together. We've got a packed agenda. I will say at the top, just kind of dovetailing with Pamela, you're welcome for the extra half hour that we have given you today, that will give you that time off, but we still have a lot that we want to cover. Before going into everything, I do want to just start with acknowledging that I'm coming to you. My square today is in Oakland, California, which is just like our office, the home of Ohlone land. And, you know, just wanted to start by acknowledging that and acknowledging ancestors past and present as we invite them into the room with us for the discussion that we are about to have. We also have some special guests with us. We've got our board chair, Cheryl Wong. Cheryl, welcome. And we also have our investment committee chair, I believe, David Ibn Ali, who's with us today. And I think I saw a couple of other trustees. I think I saw Justina and Duncan. Welcome to you as well. It's always great to have trustees in the room. For those of you who this is the first time being with us for the investment forum, let me just say that this is our opportunity to talk to you all about the things that we've done in the past year, talk a little bit at a 30,000 foot level about our investment approach, talk about some of the results of that investment approach over the last year, and talk about maybe some new things that we're doing as it relates to kind of how we align our investment strategy and the approach that we're doing with the mission of the San Francisco Foundation. And so that's generally what we try to do. And what I'm gonna do in a moment is hand it over to Mark Doherty, who's our Director of Investments, and you'll also hear from Mike Miller, who is our investment consultant from Crewcial Partners. But before I do so, I just wanted to provide just a little bit of context for today's forum. And I guess I would start by marking the moment. And what I mean by that is last year's investment forum was actually the last large public event that we did before shifting into remote work. And since then, a variety of events that we have been responding to find us, I think, in a moment today that feels nothing like the moment that we were in a year ago. When we, at one point during this summer, when we were in the throes of the protests, the hand wringing, and the unrest that was associated with the murders of George Floyd and Breonna Taylor, I had a mentor who told me that we were really responding to two viruses, COVID-19 and racism 20, and that one attacks the body and the other attacks the spirit, and that it was our job to make sure that neither one of those won. And in many ways over the last year, we have been working on both of those fronts. We have been putting together COVID relief funds with partners. We've been doing disaster relief funding. We've been working very closely with partners on the ground to listen to the circumstances that they have been dealing with and trying to be responsive to those needs and those urgencies with our grant making and through our partnership with you all and our donors. And we've also been trying to be supportive of the movement leaders who've been working on the ground to demand transformative change and to demand a response to the systemic racism that has produced disparate results, frankly, whether they're health related or economically related as it relates to COVID. When we were in I forget what it was, Mike, but it was either late March or early April when we were hit the dip and there was all the fear about what was going to happen in the market. There was this speculation around what kind of recovery we were going to have, whether it was going to be a U or a V or a W or a Nike swoosh. The reality has turned out that it was a K. And the K really represents the fact that for folks who have been so lucky to have jobs where they could work remotely or work in industries that could continue to thrive during these times, there's been a steady climb in terms of the market and their economic position. But the other half of the K represents the reality for far too many people that they have been in economic decline. People have lost jobs, people have furloughed, people have been in situations where they've had to put themselves in physical danger in order to go to work. And what's been unique for us as an institution is that we have stood literally at the middle of that intersection, where on the one hand, we have benefited from the climbs in the market, the parts of the economy that have been doing well, but we have been in very close proximity to those who have not been doing well in this moment. And because of the fact that we have sat at that intersection, we have felt a real increased responsibility to step up in a variety of ways. And I've named several, but I want to end by naming another one, which is in December, our Board of Trustees made an important decision, and not an easy decision, to actually increase spending from the Foundation's endowment for the next 3 to 5 years, and to focus that spending on communities and institutions led by and working in communities of color and pursuing transformative change. And we think it's that kind of stepping up that is required in a moment like this. And we'll invite you to talk more about that, and we'll talk a little bit more about kind of what that took and the complexities of it a little bit later on. But I just wanted to provide that context for today's discussion as we think about investment returns, what those returns allow us to do, and the kinds of things that we aspire to do and be responsive to in the future. So with that, let me turn it over to Mark. Mark, welcome. And Mark will provide you with a little bit of insight into kind of what we've been up to. So Mark.
Great, thanks, Fred. Thank you very much and appreciate your introductory comments. So I really appreciate being with you all today. As Fred said, my name is Mark Doherty. I'm the Director of Investments here at the Foundation. And what I'm going to be doing is going through and providing you with a high-level overview of our investments approach. I'm going to talk about our impact investment strategies and then leave you with an example of an investment that we feel is advancing the mission of the Foundation of reimagining and rebuilding our communities so that they have greater racial equity and economic inclusion. You know, I've found over the years of speaking on behalf of the Foundation that sometimes folks have a hard time understanding exactly what we mean by economic inclusion and how do they picture what we're trying to solve for. And so I oftentimes start with, you know, what's the other side of that coin look like? And that's economic exclusion. So where I live on the peninsula, there's a couple of towns that are separated by just a couple of miles. And the difference in the net worth of the people who live in those two towns is 100-fold. So the people in one community make and have a net worth that's 100 times greater than people who live just down the road, 2 miles down. And in that community that has the lesser wealth, actually 25% of the kids in that community are in poverty. So to Fred's point, I mean, that is a real-time example of that K-shaped curve in recovery that Fred mentioned. And that extreme and that disparity has just increased over time. So I'm going to share with you some slides and I'm going to share my screen with you now. So I hope that you all are going to be able to see here a SFF investing spectrum. Hopefully you all can see that. Somebody give me a thumbs up. Good. All right. So I'm going to be referring to some notes that I have off to the side to make sure that I capture everything that people have told me I need to be saying, make sure that I haven't forgotten any key points. So I apologize if I'm looking both into the computer screen and off to my side there, but just want to start off with a point around governance and clarifying how we actually go about overseeing the assets. So from a governance perspective, we have the board and the investment committee. They're actually overseeing the investments of the foundation. Then we have the management team, my team on the investments, working very closely with Crewcial partners who you're going to hear from after I chat. And collectively, we are trying to invest the assets of the foundation in ways that are really supportive of our mission, but also obviously generating the returns that we are targeting for the various pools and portfolios. The slide that you have up in front of you is something that I shared last year, and I think it's helpful to ground people in what we have available and what we're trying to accomplish on behalf of our fund holders. So just to walk you through, and this is going to take a little bit of time just to orient you to this. So at the top, the spectrum that you see is obviously ranging from financial investment focused to community investment focused. And then beneath that, we have different styles and approaches to investing. So we have traditional investments. That's going to be an asset manager where they're really going to be focused on driving financial returns, not really focused upon the social outcomes of the investment decision. Responsible and sustainable investing, those are going to be managers who are going to be perhaps screening out certain sectors that they don't feel are really going to be appropriate for their investment style, or maybe are antithetical to their mission, or maybe they're utilizing environmental, social, and governance considerations. Within impact investing, that's the next column over, we have two different themes there that you need to think about. One is for mission-related investing, which is where you're investing to try and generate a market rate of return, but also generate a positive social outcome. The other is program-related investing, which is where you're investing in a way that's advancing the charitable purpose of an organization, but doing it in a way that's not generating a market rate of return, but actually what's called a concessionary rate of return. That is a rate of return that would be less than what you could otherwise accomplish out in the markets. And then the far right column is called obviously grants, and that's really outside the scope of today's meeting. And there's a whole bunch of colleagues that I have in the community impact department that we can tell you about. Going into the boxes beneath, these are the options that we have available for our fund holders. They include the long-term pool and the endowment. And the reason that they're grouped together is because we use the same managers within both of those portfolios. And they're straddling traditional investing and responsible sustainable, because within the long-term pool and endowment, we have managers that are financially focused. We also have managers that are utilizing ESG considerations in their strategies. We also have managers who have said, you know what, we're not going to invest in certain sectors that the foundation has said we don't want to be investing in. And I'll detail that for you in a couple slides. The short-term pool is an option for our donors, and that is a short duration fixed income portfolio where they are investing in a way that is screening out certain things that we have asked them to. I want to just clarify, after the volatility of last year, there was a couple of conversations I had to have with folks just to remind them that this is not a bank deposit. This is not a money market vehicle. Instead, they're investing in corporate and government bonds. So there is going to be some volatility, but it's going to be much more muted than you see in our other options. Our mission aligned pool, and I'm going to tell you a little bit further about that in a couple slides. This is talking about and uses managers that have the screening that we talked about, ESG considerations, but definitely also has managers that are trying to accomplish both market rates of return and positive social outcomes. And our last option that we have listed there is our program-related investments, which is the Bay Area Community Impact Fund. And I'll talk to you about that on a couple of slides. But before I get into the specifics of what we have available in terms of the pools, see if I can actually advance a page. There we go. Hopefully y'all can see that. All right. So it says at the top, diversity is core. And the reason that we lead with this slide is to really emphasize to people that as part of trying to advance the mission of the foundation, we try and invest in ways that is increasing racial equity within the capital markets. And what you see before you are the numbers of our current portfolio exposure across all of the assets that we have, which is about $1.5 billion as of the end of last year. So we have about a third of our assets that are deployed with majority-owned firms that are majority-owned by women or people of color. As a perspective and a lens that you should look through for these data, in the industry, depending upon the source, it's somewhere between, let's say, 96, 97% of global assets are overseen by firms that are majority-owned or owned by white men. So we're quite proud of these statistics and these data. And I think the last point down at the end there is that not only is it about advancing our racial equity, but it's also about portfolio management, that we're increasing the overall performance of our pools, and we're also simultaneously decreasing the risks therein. I think for us going forward, this is definitely going to be something we're committed to. We're going to continue to do this, and we're going to continue to look not only at our asset managers, but where they're actually deploying the capital and seeing if we're going to be able to increase the investments into communities that have been otherwise underinvested. So the mission-aligned investments pool, I mentioned this before. This is one that is our mission-aligned investments pool. This is in our impact investments sleeve that I showed you on the first slide. We just concluded our second anniversary, and we're delighted with the progress that it's made over the past couple of years. As you see, we have 50 plus donors that have funds that have joined into this. The balance of the portfolio at the end of December was 90 million. As of the end of February, it's actually up towards $100 million with further contributions from some donors. So we're really delighted with the progress that this has made. And you'll see on this next slide that we're, I think, realizing the objectives that we've set forth for ourselves. And that is that we want this to be an option for donors to be able to align their investments with their values. The second bullet point, which I won't read out for you, details the sectors that we aren't investing in within this pool. And these are also the sectors that several other managers within our investments have agreed to not invest into as well. And that was something that we really hadn't anticipated when we built this, was when we created the mission-aligned investments pool a couple of years ago, we shared the investment policy statement with all of our other managers and said, these are things we don't want to be investing in. Is this something that would be feasible for you, or would that be difficult for your strategy given the way that you invest? And many of them came back and said, yeah, absolutely, we can do this and it's not going to change anything for us. So when you roll all of that together, it's about another 500 million, it's $480 million as of the end of last year that have agreed to invest in alignment with the pool, even though they're outside of the pool. So as an example, our short-term pool manager invests in alignment with these principles and does not invest in any of the sectors listed on the second bullet point. When you think of that $100 million in the mission aligned pool, 480 million in the long-term endowment and the short-term pool. That you roll that up, that's a little around almost $600 million of aligned investing. And what I don't want you to think or hear then is that the other side, 2/3, is not aligned with our investing, right? The next slide, I think, is going to give you some perspective around that. We then looked at the holdings that we have in the long-term and endowment and said, of the sectors that were on that previous slide, what exposure do we have within them in our long-term and endowment? So remember back to the first slide, we had long-term and endowment, short-term and mission aligned. The mission aligned and short-term don't invest anything in these. So only the long-term and endowment might have exposure. And you can see, as an example, fossil fuel across the remaining $1 billion that we have, it's only 1% of exposure that we have to companies that are deriving the majority, or yes, the majority of their revenues, actually more than 90% from their businesses. So we're quite pleased with the progress that we're making there. I just want to take a moment and pause. I realized on my notes that one of the things I did not do was thank my team who've been really doing a lot of the heavy lifting, and they're somewhere in the Brady Bunch screens there. But I really just want to acknowledge Jeannie and Nathan and Sarah and all of the heavy lifting that they've been doing over the past year and the seamless transition to remote work that we did. I really appreciate you and everything that you've been doing for me, and I am fortunate enough to be able to speak on your behalf. So the Bay Area Community Impact Fund, this is something which is our program-related investment strategy. It's co-led between our finance and community impact department. And what we do here is we're making loans to nonprofit organizations that are advancing the mission of the foundation. And we feel that this is a really optimal solution for a fund holder who's trying to find ways to generate community investment results immediately. And you might be thinking about, oh, I'm not sure where I want to take my grants, but I want to do something and make a change or try and address the problems now. This, I think, would be a great thing for you to consider chatting with our donor relations team to learn more about. Here are some statistics for you about the fund itself. It's a little over $25 million now, and we closed about $3.5 million of loans last year. This year actually is a tipping point wherein we're actually lending more money than the fund's balance for the first time, which means that as we've received repayments from other organizations, we're lending that money back out and recycling it into the community. And so that's a really exciting sort of tipping point that's occurred. And you'll see that we haven't lost any money on this program over the past, I think, dozen plus years. We are looking for additional capital. We definitely are open for business and want our donors to come and contribute more into this because we know, as Fred said at the outset, that there is a pressing need in the community for loans at very, very low interest rates. Specifically, the most recent ones that we've done were focused around creating community ownership models to close wealth gaps, as well as to help support small businesses in the Bay Area. So the last thing I'm going to do is leave you with an example of an investment that we have and how this is tying into our overall agenda, and how I think it's a good example of investments supporting the overall mission of the foundation. So you'll remember we talked earlier about the mission aligned investments pool. Within that portfolio, we made an investment into a venture capital firm called Urban Innovation, which is led by 2 women. That firm then made an investment into a startup, which is led by these 3 men here, called Grain Technology, and that's founded in Oakland. And just some statistics and content there for you. So Urban Innovation, led by 2 women, 2/3 of their startups that they've invested into are founded by women or people of color. By industry standards, that's just off the charts. By contrast, most VCs on the industry have invested about 4% of their capital to women and just 2.5% of their capital to founders that are Black or Latinx. So again, 2/3 of Urban Innovation is going to startups that are led by women and people of color. So just a couple of comments about Grain. They provide lines of credit towards individuals' debit cards. And as I did some research about this and learned more about this, I learned that just two-thirds of millennials and 50% of Gen Z don't even have a credit card. So what that means is that they're having a difficult time creating credit scores, credit history, things that you need when you go to rent a car, buy a house, et cetera. And obviously there's a moment in time of people having difficulty with cash flow. So that's what Grain is trying to solve for. And I think the last point that I'll leave you with is to just deepen that through line that I'm trying to draw for you here between the agenda that we have as the foundation, our mission aligned pool through urban innovation, through this company, is that the bank that's providing the financing to Grain behind the scenes for those lines of credit is actually what's called minority depository institution, which means that the majority of their board or the majority of the business of that bank is within communities that are predominantly minority as defined by the Fed. So I think it's just an excellent example of that thread of consistency that we've tried to be very intentional in the deployment of our capital. So with that, I'm going to stop sharing and I'm going to turn it over to my colleague, Mike Miller, who's going to share with you a bit more information about the long-term and endowment, as well as some of the results that we've been able to accomplish for you. Mike?
Great. Thank you, Mark, and good afternoon, everyone. It's really nice to be here with you. I was thinking back to Fred's comments earlier. I'm Chief Investment. By the way, my name is Michael Miller. I'm the Chief Investment Officer of Crewcial Partners. Our firm was formerly named Colonial Consulting, and we decided to adopt a name that reflected who we are and our commitment and alignment with our clients. And the words and the wisdom you heard from Fred and Mark today about the incredible work of the foundation is just a great example of what we try to make a contribution to from the investment side of things. This is our leadership team. Just as a quick background, Dean, Melinda, and I have worked together for a long time, about 25 years. Patricia Wortham is our head of human resources. She's been with us for more than a decade. And Kanisha is the new person on the block. She's our chief compliance officer. She's only been with us for 3 years. But we have a great team. And our goal in life is to support the work of the foundation in every way possible. And what I'd like to talk with you about today is the return generating side of things. Mark did a great job talking about some of the things that are done, and I'll take you a slight step into the weeds here, and I'll try not to make it too boring or technical. And I will admit that I woke up this morning with horror and realized I had too many slides. So I'm going to try to figure out how to squeeze this into my 15 minutes, but we'll do the best we can. And I apologize if I veer off into New York City speaking too quickly like a New Yorker sometimes do. So this slide looks at the target returns, which are the blue bars, which are our long-term projections, 10-year projections in this case, for each of the pools. And Mark touched on each of these before. And the red bars reflect the actual 10-year returns for the short term, the long term, and the endowment of the MAI pool, the mission aligned pool that Mark talked about. Actually, I'm surprised I can say this today, but it was fortuitously started in March of 2019. I don't think I would have thought that 9 months ago. But with that said, it's had a fantastic 17% return, while the other two pools have meaningfully outperformed the benchmarks, or expectations, I should say. And we're really proud of this because this is what I think allows Fred and the foundation to do the things that are being done, particularly at this really, really difficult time in our society. So now here are the actual investment results over time. This is all through December 31st, by the way. So the orange bar is the mission aligned pool. The red bar is a 60-40 blend of stocks and bonds. We use that as a benchmark. And the blue bar is the long-term pool. And then last but not least, the green bar is what we call the MSCI Investor Force ENF Median, which is basically other endowments and foundations. So the first thing you can see is that the place to have been last year was clearly the mission aligned investments pool. That's in part because it's got more stocks than actually the blue bar does. It's also in part because of its ESG focus, it actually tends to avoid some of the older industries in the country, not some which are perfectly reasonable places to invest, but more technology, more healthcare, and that's been a wonderful place to invest. I will tell you that the gap you see over this short period of time between the MAI pool and the long-term pool will close, and it'll close quite a bit. Our goal is for both pools to be extremely successful, and 1 year doesn't really define that in either way, shape, or form. Now, if you look at the other bars, though, I want to draw your attention to the fact that the blue bar, with the exception of last year, has been ahead of both of its benchmarks by pretty significant margins. And what I'd like to highlight is what that means over time. So when you go back to the slide I showed you before, the numbers and the differences don't look that significant. But when you really want to talk about the foundation's assets durably supporting your community and your interests and your needs, what happens is you really need to basically take superior returns and try to execute that for as long as humanly possible. And what's really interesting is first of all, you can see how the 5 and 7 year returns, while great, really pale by comparison to the longer term returns and the big returns that have been earned over 10, 15, and 20 years, again, on a cumulative basis. So these are not per year, of course. And what's really important, I think I want to just draw your attention to a couple things. One being that the blue bar, which is the long-term pool again, has exceeded our actual main benchmark, the CPI plus 5%. So that we've changed what the green bar means here, by the way. This is no longer the average endowment foundation. It's now consumer prices plus 5%. And that's an incredibly important measure as we think about the long-term pool, basically either maintaining its purchasing power or even adding to purchasing power over time. So what's important here is to look at is the red bar versus the green bar, particularly for 15 and 20 years. And you can see that actually a simple portfolio of stocks and bonds did not achieve the goal. It did not preserve the purchasing power of the assets. And that is a massive, massive concern. And I'm going to come back to that a little bit later because we have some worries about the future there too. But what's really important here is the long-term pool, which are the blue bars, and these are net of investment management fees, has actually not only beaten its benchmark, but more importantly, for 15 years, it's actually added purchasing power to the portfolio compared to CPI plus 5, or to the assets, I should say. And over 20 years, we matched it, which matching isn't really what makes us wake up in the morning, but we'll take it given how hard it was to catch that measure, given just a simple 60-40 portfolio. But one of the things we are really excited about on this page is every single time period you can see here, the long-term pool has either matched, as I said, for 20 years or exceeded its true long-term benchmark, which is CPI plus 5%. So how is this done? And for those of you I've been with before, I will be very quick to say it was not done, no offense to my investment committee members I've seen in the audience here, but this was not done through acts of genius. This was done through taking advantage of long-term opportunities and the duration and the scale of the foundation's capital. Just to give you a quick contrast, a lot of people make investment decisions based on the economy, based on a short-term view of interest rates, based on a short-term view of a lot of different things. And we quite purposely avoid those things only because we really don't think that we have any edge. And we also don't really know how anyone can predict the future. So we're very wary of anything that involves predicting the future. So what we'd prefer to do is hire great investment firms who are wonderful long-term thinkers, who are wonderful at assessing the quality of businesses, and then just own a very nicely diversified portfolio of businesses, stocks, bonds, and otherwise, that are trading for prices or valued at prices where we can buy at prices that are lower than their fundamental value. And then all we do is wait. If it sounds simple, that's because it is. The patience and the emotional side of it can be hard at times, but the reality is what we're actually doing in this portfolio is very, very simple. So this slide gives you a view of the strategic asset mix differences between the two pools, the long-term pool and the mission-aligned pool. And you can see what I referred to earlier, which is the mission-aligned pool has a lot more in global stocks. It doesn't own hedge funds because that's a very hard strategy to execute with an ESG mandate. It has less in private assets. That's a temporary thing, we would argue, because it's just a brand new pool. So it takes time to build a private asset portfolio, but it's a very important part of the strategy. And of course, to offset that, it has a little bit more, or a lot more, actually, I should say, in fixed income, 30% versus 20%. What I would emphasize as well is that both of these pools have a lot of their assets in long-term, higher return asset classes. And that is incredibly significant for us because if you go back to the slide before, which I won't go back to, but if you looked at it later, you'd see that we talk a lot about CPI plus 5, CPI plus 5, CPI plus 5, but we need to own assets that can get us there. And so we're going to basically emphasize these assets all the time. We're going to stay diversified to protect the portfolio, and I'll talk about that in a minute, and to protect your grant making. And we're also going to accept compensation, accept volatility, but we need to get paid for that. And that's the claim or the promise we make to you, which is that we will take on risk, but we'll only take on risk when we think we can get paid, and i.e. your funds can grow in value as a result. So returns, that's all great. The fact is though, and when you listen to what Fred had to say before, we live in a world where there's need. And at times that need is constant and it's never ever ending. And at times it comes out like it has in the last year and just becomes an incredibly powerful force that cannot be and should not be ignored. So you need to have a portfolio that's both long-term and short-term at the same time. And that's where the diversification strategy that we use comes into play. So this chart is meant to try to show you how we think about the balance we're trying to achieve. So what I haven't really talked about, and I don't have a great chart to show this to you, but one of the key things the portfolio's done over the years is by maintaining its diversification, by maintaining its balance, by maintaining its contrarian thinking, we've really worked to put together a set of assets that don't behave in lockstep with one another most of the time. And what that does is it allows us to generate the returns we seek, but also keeps the volatility of the portfolio under control. Diversification, when well executed, really does work. And the goal, again, is to essentially earn as much return as we can with a reasonable level of volatility. So how do we show you how this works? And so we thought this was a neat way to do it, which is to go back to July of 2000, and that date was picked for a reason. That's actually when our firm, and I actually personally started working with the foundation. So it's been a really wonderful 20-year plus period at this point to work with an incredible investment committee and organization. But what we did is we said, let's take and pretend hypothetically that $1 million fund shows up on June 30th or July 1 of 2000, and it was invested in one of 3 portfolios. The blue bars being the actual long-term pool. So I said hypothetical, that's just the time period, not the performance you're looking at. The orange bars is that 60-40 mix I mentioned earlier. And the gray bars are the S&P 500, which of course has been one of the dominant places to invest over the last 10 years in particular. So the other things we did, just to give you a couple more things to level set this, we also assumed that nothing was added to this fund from 2000. So what you see here in all these numbers is just the original $1 million. Plus, we assume that 5% of a 20-quarter rolling average was taken out, basically each and every year along the way. So the first set of bars, 12/31/20 or December 31st, 2020 fund balance, shows you that it's interesting. The investment in the long-term pool actually ended up at the end of the day with more left in the fund than either the 60-40 mix or the S&P 500, despite what's happened the last 10 years. The second thing, which is really important too, is the middle set of bars, which not only did this fund end up with more capital at the end left in it, it actually distributed more over time. And then the third set of bars just really kind of adds the first 2 sets of bars together. So we take the first bar, we subtract the $1 million that was the gift, we add on the charitable contributions or distributions, I should say, and we end up with that gap. And you can see that combination of more money left in your fund plus more going out the door is at least to a really, really incredibly important difference in how a fund can perform in a portfolio like the foundation has in the long-term pool. Now, you might say, well, okay, but isn't the S&P 500, for example, cheaper and easier, and maybe it'll catch up over time, and that's possibly true. But let me show you the other problem, which we think about a lot, which is how do you fund grant making over time? Again, thinking back to what Fred said and what's necessary and important in this community today, we can't just say, well, the S&P is down, so we're going to stop making grants. That's really not the way it gets done. That's insanity. So this graph takes that middle set of bars you saw before and breaks it up year by year. So you can see the pattern of distributions. And what you'll see is because we happened to start this exercise and we joined the foundation as an advisor in 2000, there was an immediately very difficult bear market in 2000, which is why you see that gray line with the S&P 500 plunging the way it did. And what's fascinating is the S&P 500, just to pick on that for a minute, has basically had, essentially from 2000 to 2012, did nothing but go down. So think about that as a philanthropist. I mean, there's not a single cause or organization in the world which could tolerate 13 straight years of just nothing but essentially losing more and more funding. And of course, now you can see what's happened the last decade is that gray line has started to soar back higher. But that's just a nightmare, what you're looking at here. And that's why a very, very heavily equity oriented, particularly in the top S&P 500 names, is really a frightening strategy. Now, the blue line you can see is the foundation's distribution pool. Now, it's not perfect, but for the most part, it goes up over time. And I think what's particularly interesting, I know this is where the 20-quarter average is so important. You can't even see the pandemic in these numbers at this point. If you look to the far right, you'll see that blue line is essentially flat to slightly rising. And that's because we're using this 20-quarter average. And so it's just an incredibly important way to protect your funds and make them basically accessible to the needs that you are trying to serve. So let me just go back to 1 or 2 more quick points before I wrap up, which is to talk about what frankly keeps me up at night, almost every night these nights it feels like, which is that we live in a world, Fred talked about the K-shaped recovery, and there have been a lot of people who have been fortuitous to have investments that have soared in value over the last 12 months in particular. And that's great for those people and actually for the capital that they can generate for others. But at the same time, it's created a major problem, which is that the US stock market today, and forgive me, this is a little technical, but I will not bore you to death, I hope. The US stock market, particularly because it's led by names like Apple, Amazon, Tesla, et cetera, has become incredibly expensive by any long-term measure. So again, we're not making a prediction for next year, but we do know that when we look at valuation, the way I'm about to describe in a minute, there's something to really be nervous about here. So this is something called the Shiller ratio. And for those of you who don't think all day about financial stuff like this, the Shiller ratio is a construct that was came up with by a guy named Bob Shiller, who was a professor at Yale, who wanted to essentially figure out a way to value the market without having all the cyclicality of earnings, the cyclicality of the economy, and all the things that really do drive shorter term outcomes in the markets and with earnings in particular. So he took the 10-year inflation adjusted average of the earnings, that's the E, and just took the current price of the market and divided it by that. So what we did is, so he's a really generous guy, and on his website, you can take a look at basically all the Shiller ratios back to 1880, I believe it is. So we took all those monthly numbers and we said, okay, what was the next 10-year return for the market? And for those of you who have some investment background, you won't be surprised to hear that what tends to happen is that when prices are high, future returns are low, and when prices are low, future returns are high. And so what you'll see on the far right-hand side of the screen is what the median return was from each single bucket of valuations that we had. So just two more quick points. The first being that the Shiller ratio today is about 34, 35. So we highlighted those two orange shaded lines, and those lines should tell you a couple of things. One is, take a look at how infrequently, number of observations, that the market's been this expensive over time. And then if you want to pick on either of those two lines, I'll take the bottom one. The median forward 10-year return for the S&P was 3.3% with if you had a 30 Shiller ratio. So this is a really significant issue. So you can certainly say, well, maybe this time will be different. And gosh, I hope it is. But the reality is that we don't like to make investment decisions or suggest to you make investment decisions based on the future being radically different than the past when it comes to basic laws of how investing works. So what we're terrified about is that if people are going to, or if investors are going to have, big chunks of their money in stocks, and they're going to favor our home markets, and they're going to favor the S&P 500 specifically, there's a fairly high probability that over the next decade that they will earn very, very moderate returns at best. And then if you mix that with the fact that we have very low interest rates today, you end up with what looks to us like an absolute disaster in the making, which is investors over long periods of time potentially only earning 2 or 3% per year on endowment funds. And if you're spending 5 plus inflation, the math is really, really terrible. In fact, you can create a hole from a purchasing power perspective that is almost insurmountable. And so this is a really, really challenging time for investors. Now, I do have some notes of optimism for you, which is that we don't actually think the foundation portfolio is going to suffer. We're going to have the headwinds of very expensive US markets, but this portfolio is much more diversified than that. It's globally diversified, it's focused on contrarian investments, and we don't allow, we minimize, I should say, the slippage that comes from doing things that are based on short-term forecasting, all the things that really can cost you return. Those are major issues for us. So we think that there's an interesting time here. This is an interesting time to make contrarian investments, to go to places that are out of favor that people don't like. That's where the valuations and the values and the opportunities are the best today. At the same time, we're going to apply our same patient long-term focus. And finally, having, as Mark said, $1 billion and $1.5 billion to invest allows us to access some incredibly talented people who are doing things very differently than others. And that in turn can get us to the place where we can overcome these odds. So thank you so much. I'm going to stop sharing my screen, and I will be quiet now.
All right,
Thank
great.
you,
Thanks,
I
Mike.
think we're going over the question and answer now.
That's right. That's right. And I think, Fred, maybe I can just remind folks there's 2 ways to ask questions. One is to ping the chat moderator in the chat privately and post the question there, or there are instructions in the chat as to how you can go ahead and raise your hand. So Fred, I'm going to ask you just to start off with a question, kick things off, and then I'm going to follow over to David Ivanali, our investment committee chair, with a follow-on. But you mentioned at the top about the decision by the board to increase the spending from the endowment. I was hoping you could maybe share some perspective about any plans that you have for that spend, given the crises that you talked about in the current state.
Sure. So just a couple of things. One is that this was a very complicated endeavor. I mean, the thing that's different about being a community foundation that's different from being a family or a private foundation or a corporate foundation is that our corpus is actually made up of 251 different trusts with different kinds of instructions and expectations associated with them. So our finance team had to go through quite a complex analysis to provide the board with the kind of information that was needed to make a decision like that. As I talked about, though, what we plan to do with those dollars is really dedicate them to organizations led by and working in communities of color, and also pursuing transformative change. One of the first recommendations that we're bringing to the board that comes out of this increase in spending is support to the California Black Freedom Fund, which is a collaborative fund that's being put together, focused in on California and supporting Black-led movement leaders and movement organizations to really pursue transformative change in California. It's a $100 million fund. It is populated by a who's who list of foundations in the state of California, and it will be feeding a group of folks that are doing really important work, but not had the kind of fuel that they've needed to be as impactful as they've intended to be. And so that's an example of the kinds of things that we will be doing with increased spending, and we're really excited about it.
Great, thanks, Fred. So David, I was hoping I could ask you for your perspective, both as board and investment committee chair, as you went through that process and, maybe the decision around it, but also your ambition for this increased spend. Yeah, we're on mute. Can't hear you.
There we go. I was on forced mute. Someone didn't want to hear from me. I should start by saying thank you to everyone for being here. The answer to, I have a bunch of different ways of answering your question, Mark. I think the first is that Mike just finished talking about outperformance by the foundation over extended periods of time. Against, with respect to purchasing power, against our peers, against our own benchmarks. And that outperformance over an extended period of time has in some ways bought us the flexibility to do what we've chosen to do. This is the reward for that performance by multiple investment committees has been to give us the resources to do what we're all here to do the work of the foundation, which is at a point in time where it's needed more than it's ever been. And so at a high level, I get really excited about that. I think the investment committee to a person was excited about that. I don't think it changes the way we do what we do. And it's sort of, in some ways, the change, there's a lot of stress behind what change we're trying to drive. As an investment committee, it continues to be about being slow and steady and having great hands on the till. And so we're talking about what was a very well thought out increased investment over a short period of time. And again, how we think about investing the foundation's dollars is not about that short period of time, but it's about the next 5, the next 10, the next 20 years. And so I couldn't be more excited about the opportunity to lean in at a point in time where we can have a meaningful impact. And I think the committee was excited about that.
Great, thanks, David. Appreciate you. Question came in, and I'll tackle this one actually because it's about specific to the mission aligned investments in the sectors that we do or do not invest in. The question was, are prisons and detention centers included as a screen? And so I didn't mention this in the process of how we've decided which sectors to screen or not. Really, it's a voice and representation on behalf of the management team. And I work with them and our CFO, Sonia, and we sit down and we meet as a team and talk about where do we feel are the greatest misalignments? And when we put this together at the time, private prisons really were something, and predatory lending was a key point that we felt were really sort of the most antithetical to the work that we're trying to accomplish as a foundation. So where across all of our assets, we don't have exposure to those two. Prisons as a whole, I can't actually speak to. I'd have to actually look into that and say what is our exposure into prisons. But we can take that and come back into follow on with a response to that. Let's see. Another question, and I'm going to pose this one over to you, Mike. This question is about it's asking that the foundation seeks to invest with funds that are run by women and people of color. How do you source these managers and funds, and are they difficult to find? So Mike?
So I'd be happy to talk about that all day. So basically, just to give you a quick version of the story, about 8 years or so ago, we were asked by a client, so tell me about how many women and people of color manage money in my portfolio, and also tell me whether or not you guys are even meeting with women and people of color who manage money. And of course, I very confidently said, well, of course we are, because we're not biased. And then we went back and looked at the data, and I don't think we were biased, but we were not doing a very good job at all. So we started on a slow and steady process, which has accelerated over the years, to focus on sourcing. So that question is really important. And the most important thing we did is about 4 years ago, we hired someone named Angela Matheny to join our firm and be in charge of what we call diverse manager equity. And her job was to literally go out in the world. She must have attended 100 conferences and just tell people, hey, come talk to us. We can't promise you we're going to recommend you to anybody, but we promise you a fair hearing. And so over the years, she has generated tremendous deal flow. She's been so successful that we have currently today, by the way, across our firm, we have, I believe, just shy of 50 diverse managers that we recommend to clients. And they have over $4 billion of our clients, about 30 billion of capital allocated to them. And we are just getting going. So it was, I have to tell you, the hardest thing about it was convincing diverse managers that it wasn't a waste of their time to come talk to us, because unfortunately that is their experience a lot with advisors like us. And so obviously now we've built a reputation, so it's gotten much, much easier these days, where people assume at least that we're going to give them a fair hearing. They don't always like our answer, I will admit, because we really are very difficult, I have to admit, on everybody, but that's how we've done it. And Angela is such a fantastic success that she actually now runs the entire investment team at Crewcial with me. So she was promoted early in 2020, and we've now brought a second person on the team to do more of the sourcing of diverse managers. And the last thing I'll tell you is our entire investment team is fully engaged on this. And I will say there's not a single person who works at Crewcial on the investment team who doesn't know how excited I get when we find another great diverse manager. We love to find all kinds of managers, but it's particularly exciting to find another diverse manager to add to our list. And I think that's very motivating for all of us. So that's how we do it.
Great, thanks, Mike. I'm going to follow up with you actually on another question that came in, and trying to explain the role of hedge funds in the long-term and endowment portfolios. And I'd actually just maybe ask also that you comment upon GameStop and our lack of impact from that.
Yeah, so hedge funds, we sometimes have a slide, but I had too many slides, so I didn't have one, but maybe we can try to get this out to everyone later. But so hedge funds have actually been an enormously successful part of this portfolio. I know that may come as a surprise to everybody, and I'm going to tell you exactly how we define success in a minute. But basically, and I realize that most people's hedge fund experience is radically different than that. But hedge funds are not really an asset class. They're a group of skilled investors at the end of the day. And the foundation's been, I think through a lot of good decisions and some luck, managed to avoid any major problems in the hedge fund portfolio over the years. Thank you, investment committee, because I know I brought at least one or two ideas that thankfully didn't get into the portfolio. But with that said, the portfolio has generated, since we first put hedge funds here in 2000, it's generated, I know it's generated returns that are above both the S&P 500 and the All Country World Index, and they're actually above the endowments as a whole. So we've earned, I want to say 9% returns per year net of fees. And that was done, by the way, with half the volatility of the stock market, because hedge funds, and that gets to the point, which is if you can get good returns, and then as rare and difficult as that may be, you can get a diversification benefit that really means something. And lowering the volatility of a segment of your portfolio and giving you an alternative to bonds to do that is super important. And it gets back to that slide I showed you earlier with the charitable impact and the philanthropic impact, one of the major ways this portfolio has moderated its volatility over the years has been with hedge funds. So it's been a really, really important, successful part of the portfolio. And obviously, and the investment community members and David, I'm sure, could jump in here too. It's successful until it's not. Nobody gets a lifetime contract in this portfolio, and if it doesn't work, we'll move on because hedge funds are a tough place to win. And last but not least, to Mark's point, there was no GameStop in the portfolio. Just not to get into the weeds too much, but we do not like any kind of investing that involves popularity, for lack of a better word. And so the idea of short selling companies that lots of people are short selling, that's our version of popularity. That's anathema to us. And it's only because you just don't know what's going to happen. And we wouldn't have predicted GameStop or any of these other meme stocks. But the fact is the portfolio had no exposure to that. And it was really by design because we really like to find people who are doing something that kind of off in right field by themselves, doing their own thing. And that's a good way to stay out of trouble, especially in hedge funds.
Okay, Mike, thank you very much for the perspective. And just to be respectful of everybody else's time, we're coming up on the hour, so we're going to have to stop on the Q&A. And I would say that I believe that behind the scenes, we're capturing the questions that are in the chats. We can be able to follow through in terms of a post-op relationship from the donor relations team to come back to folks with some of the answers. So I'm honestly not sure who's going to be taking the close on this, if it's going over to Fred or to Cheryl, I'm not sure. So
I'll send it to Cheryl. Thank you all. Thank you, Mike, and thank you, Mark, for giving us a lot of information in a shorter period of time. And thank you, everyone, for tuning in. I will turn it over to our board chair, Cheryl Wong, for closing remarks. Cheryl.
Thank you, Fred. First of all, I'd like to thank everyone for attending and to tell you that we would like your feedback on this session. You'll be receiving a follow-up email from us in the next few days that will include a link so that you can access the slides and things that you've seen. And if you have any questions or comments, please choose the link that will send you and allow us to get feedback from you. It's really important that you do that because, after all, we are a community foundation. We're we value all of you. We value our donors and our grantees and feel that it's very important that we listen to everyone. So I hope that you've enjoyed this presentation. And again, if you have questions, be sure that you share your questions and comments with us. And thank you so much for your participation. Goodbye.